Hi friends, Senate Eskridge here. Give me just a second here as I get my technology all up and rolling. Hi friends, Senate Eskridge here. Welcome to my February webinar series. Today, we're going to talk about how to build an alternative asset portfolio. A little tagline sub below is building cash flow resilience from long-term wealth beyond stocks and bonds. You guys, we're going to talk about a lot of things here today. So I'm going to have a lot of terms and things like that. I'm going to do my best to explain all of them to you, but feel free to put your questions down in the Q&A or even the chat, and I'll do my best to answer them as we go. And then we will absolutely have time at the end to be able to ask any questions or anything like that. So let's dive in. Let's talk about how to build a alternative asset portfolio. First, we got to talk about, the definition of what's called a safe portfolio. This really what we're talking about here is, what the big brokers. I don't want to call anybody's names out, but the ones that everyone can look up on Google and they're going to help you invest money into a stock market portfolio, and they're going to balance that out, with some stocks and some bonds. But really, what a lot of these people do, in pure honesty, and I'm picking on the entire industry, not an individual company or even an individual advisor. There are some really, really good ones out there, friends, really good ones. And those ones that you can find that are good are worth their weight in gold. Okay. But a lot of them, they simply just go and put your money into a bunch of index funds. Uh, and then, which is something you can do yourself, right? You can create your own brokerage account with any of the big companies, TD Ameritrade, Schwab, Thinkorswim, any of those companies out there. Heck, even the app ones. Can't think of them right now off the top of my head, but you can literally invest in these same options, the index funds, without having to pay an advisor 1 to 4% on your money. I mean, it's absolutely insane what some of these people charge and how little work they actually do for their clients. Now, again, there are some that are really good, so keep that in mind. There's nothing wrong with them if you have an absolutely good one. But the problem is, again, these stock market accounts, they're really designed for the 401ks, the old school thing where you just put a little bit of money in there and you're investing on a regular basis. And what they do is they diversify it and they give you access to the entire 500 stocks in the S&P 500, for example, or the entire 2,000 stocks in the Russell 2000 index, as an example, right? And what you're doing is you're buying a weighted average of all of those stocks. And the theory is that diversification is going to keep you safe. Okay. But the challenge is, actually, sorry, go back a slide. Sorry, I'm not ready for that slide yet. The challenge is, you guys, that these things are very heavily correlated. And I don't know the exact number. That's not my business, but the Google is something like 30% of the S&P 500. And so the S&P 500 is very, very correlated to Google, right? So you can actually look up the exact correlations online. That's not the point of this webinar today. You can go find those on your own. But if it's 30%, what that means is, let's just say that if all the other stocks are flat and Google goes down 10% by itself and all the other stocks stay the same, the entire index would go down 3%. Well, the problem is there's so much groupthink in the stock market, right? That the index goes down 3%, everybody's going to sell. And so now maybe it's down 5% or 6% because they're all following the trends because everything is so directly correlated. And that is something we really want to get away from. And so what we're going to look at today is investing beyond stocks and bonds into alternative assets, things that you can actually own. These are things that are outside of the public markets. This says right here, typically publicly or privately held or structured. Really, what this means is you need to have special access. You need to know someone to be able to get into these deals, right? Because they're not traded on the public stock market. So you have to know someone like me or some of my friends that do the same type of thing that I do, and you invest through a particular person or through an organization that focuses just on these alternative assets. And really, most of the time, these things are physically or backed by something tangible, right? Like an apartment building or an RV park or an oil well or something. We're going to dive into some more of that in a few minutes. But again, remember, you have to have access. And this is really what we're looking to get to, right? We want to move from accumulation to cash flow. We want to start being able to remove some of that money back out here to you, right? And create these bullets on the right, the reoccurring income, economic independence, and you get to own and control your cash flow. So what is the case for alternatives, right? So first one, as I alluded to, kind of beat up on for a few minutes, is diversification and correlation, right? So, you invest into, say, um, a bourbon distillery or a bunch of oil wells, right, that I have, and they're not correlated at all to the stock market. It's completely separate. The stock market goes up and down. It will not impact your bourbon investment, for example, right? Um, so diversification and non-correlated investments. The second one it talks about here, the second bullet point, is inflation-resistant assets. So let me think about this for a minute, right? So inflation is the enemy, right, of the average person, right? So if they have income and their income is pretty much set, let's call it, say you make 100,000 a year, and you're going to continue to make $100,000 a year for the next, say, 10 years. Well, if inflation is 3%, right, and so you could just assume, easy math, right, that your income need would go up 3% per year, or to be up to 130,000, or to say it the other way, that it's like your income, it's like you're now making 70,000 because it's 3%, 3 times 10 is 30. So you go 30 or 30, but that's not the case, you guys. Inflation compounds. And so 3% for 10 years is more like 55, 60%, somewhere in that range of the actual difference that you need to make. Now, if you own an apartment building or another tangible asset where the income is actually tied to inflation, and the more inflation goes up, the more your income goes up, well, that's actually a good thing, because let me break this down for you. Let's say we buy something at, call it $1 million. We hold it for 10 years. The same 3% has happened every year for 10 years. And now our income's gone up 50%, maybe even 60%, but we still only owe that $1 million. And we've been paying it down now with more valuable money. So in a sense, it's like it's paying down faster, which is absolutely phenomenal. If you have the right kind of assets, inflation can actually be a really good thing. The third bullet point, not tied to market swings. The biggest reasons, in my opinion, okay, this is not scientific evidence, this is Senate's opinion. The reason we have such giant swings in the stock market is because they're liquid. If you get scared and you think that NVIDIA is going to go down with the next earnings, you can sell your stock. Well, enough people sell their stock, and it's just supply and demand that goes down. Well, the exact opposite could happen. You remember the whole GameStop debacle? There was absolutely no legitimate reason that stock was going up. Just somebody pumped it, and then it caught fire and kept climbing. Well, that doesn't happen in these private equity things because they're not liquid, and some people say that's a bad thing. I actually say it's a good thing. And then the last one, potential for double-digit returns with lower volatility. That's huge, friends. The average stock market investment over the last, like, long term, 30 years, comes out to be about 8%. These private equity investments, we look to double your money every 5 years, which is a 20% return. Again, they're calculated a little bit different and things like that, but it's a very wide spread between the two. All right, we got to keep moving. We got a lot of slides to cover. So here's a couple categories of things that we look at, and we're going to talk about each one of these individually. So I'm not going to spend a lot of time here, but here's just 5 different asset categories that I work with, and we work with several others. I just want to talk about these. The first one is institutional grade real estate. These are things like apartment buildings, build to rent developments, things of that nature. Again, physical assets you can walk up and touch. And so when I talk about this, why would somebody invest in an apartment building? The most common question I get is, why wouldn't I just go buy a duplex and rent it out? The problem with that is you become a landlord. You got to deal with the troubles of real estate, tenants, toilets, termites, things of that nature. Uh, I literally just before this call got a phone call from someone at one of my properties, and they hit a gas line with a backhoe, and there was this giant fireball that happened. Luckily, nobody got hurt, but I have to deal with those problems because I'm the owner. If you want to invest in an apartment building, okay, now you invest with me in one of these. My team handles all of the work, okay, and does everything for you. And all you have to do is worry about 3 things at the end, right? At the end of the month. You got to read the investor update that gets sent out to you. You have to deposit your check. And at the end of the year, you have to send your K-1 or your tax document to your CPA. You don't get calls in the middle of the afternoon saying there was a giant bomb that just went off, right? Because somebody hit a gas line. I deal with all of that for you. A couple more bullet points of why real estate syndications are good. I just covered this, right? Sponsor versus passive investor. We do all of the work for you. We make the major key decisions. We handle all of the problems. You get to sit back and collect all the benefits. Then you also get on the right, it talks about, as a passive investor, you get cash flow well from holding these. This does honestly in this type of asset, this starts off fairly modest, usually in the beginning, but that can ramp up to be pretty significant over the long term. And then when we sell the property, that's when you get the big chunk of cash. So you get to participate on both sides, cash flow and equity. Well, what about something else? What about specialty assets? Well, one of the investments I'm actually helping people invest in right now is a white label bourbon distillery. Yeah, so we're going to actually build this building that's in here in this webinar right here on this side. We're going to build this building and we're going to produce white label bourbon. This is not a time to pitch this, but just imagine a 40% annualized return, and 10 times your money in 8 years. These are the types of opportunities that we can get into with these specialty types of assets. A little bit more detail and some more color in here. These are typically like businesses. Last year we bought some paving companies. I'm actually looking at a marijuana grow facility. I'd love your feedback, right? If anybody on this webinar, thinks that's a good thing or a bad thing, if that'd be worth bringing out. But if we can get paid 40% annualized on these types of investments, why not do something like this? Another example is niche real estate. These 2 slides talk about RV parks. RV parks are very, very fractionalized. They really haven't been institutionalized yet. So they're really ran by what we call mom and pop owners, or people that are doing their books with Excel sheets and things of that nature. And they just don't have a lot of the software or efficiency. So there's a lot of room in here to come into these RV parks and really modernize them and make them a true business. Imagine the difference between like literally a mom and pop hotel with the front desk guy lives there, and he's the manager and the handyman and everything, right? Versus walking into a Hilton or a Marriott. Very, very, very different experience. And that's what is happening right now in the RV park world is we have these mom and pop owners, and this is getting taken over and being more institutionalized, which is translates to really good returns for you. I'm also looking at some glamping sites that are interesting in this kind of realm. I'm also looking at some marinas, some boats on the water, right? So you can actually live there on the water in a boat if you want, or just park your boat when you're not using it. There's lots of these niche real estate funds out there. Another opportunity are private debt funds. really, this is kind of like a CD. I don't want it, I'm not directly comparing it to a CD, right? Because those are FDIC insured and they're done by banks. They still have risk, by the way. You can put your money in a CD and the bank goes belly up, and if there's a run on the bank and the FDIC insurance runs out, they'll only insure you up to 250,000. Actually, I heard they just increased it to 300, maybe. I got to double check that. But anyway, it doesn't matter what the limit is, there is a limit. And after that limit, all your money is at risk. Okay, so but what these do, just like an IRA, or I'm sorry, like a CD, we're going to take that money, you're going to deposit it with us, and then we're going to go create loans for it with other people. And the other difference is a CD is going to pay you 3, maybe 5% if you're lucky right now. And I've got debt funds that pay 14%, one that pays 15%, even one that pays 16% interest, right? So just so you know, at 14% annual, that comes out to be on a $100,000 investment, comes out to be $1,166 a month. If you can use that metric to figure out how much money you'd have to put in one of these debt funds to cover all of your bills every month, it's not that much. Okay, so next slide, a couple more examples. This is an example of a merchant cash advance fund on the left. And so what they're doing is they're literally giving people advances on their credit cards or credit card transaction process. Sorry, rather. So the business processes credit cards, and they use this as like a line of credit against what they've drawn. On the right, this talks about small business financing. So these are typically short-term loans tied to their accounts receivable or their collections or something like that. They have to guarantee them. And they do pay pretty high interest for those. Next example, next asset class I just want to show you. And again, I'm going over these really high level on purpose. I can dive into any one of these with you in more detail. Anyone that sparks your interest, let me know. And the next one is diversified asset funds. So last year, we raised capital for 240 oil wells in Wyoming and South Dakota. And when it was all said and done, I calculated my ownership. We bought 240 oil wells, and I personally own 1/2 of 1% of 240 oil wells. And so you do the math again, and that comes down to be the equivalent of 1.2 oil wells that I own. And I think the fact that I have 1/2 of 1% of 240 is better, because if you only own one and it dries up, you're not going to make any money. So we do these same types of things with solar. We can do them with natural gas producers, oil producers. This section would also be where like AI would come into, like if we're going to do a data center or something in that realm. Power plants, they'd all fit into these diversified alternative funds. Again, asset diversification. I already told the story about the oil well, jumped the gun there. All right, so the number one objection I hear when I'm talking to people about investing in these types of things, I don't have any money. I don't have the capital to invest in alternatives. Well, first, let me just say, back up. I said a minute ago, talking about a duplex, right? The average down payment on a duplex, let's say it's like 20% down. Maybe you can get it lower than that. But at $300,000, that'd be $60,000 down to buy a duplex. At $500,000, that'd be $100,000 down you have to come up with to buy something that maybe is going to cash flow $100 a month, $200 a month, something like that. So if you just think about that and comparing it to a duplex, first of all, a lot of people have money, right? Because if you can find money to buy a duplex, you can find money to put one of these. But let's get a little bit more specific on a couple of things. How can I help people find money? Well, the first one is in retirement accounts. Okay, so I've got several companies that I can use where we can take an IRA, doesn't matter if it's a Roth, a SEP, a traditional IRA, an inherited IRA, doesn't matter. And we can roll that money over, and then we can use that to invest in these types of assets. Also, if you have a 401k from a previous employer, we can roll that into a self-directed IRA. We can also set up for you a solo 401k if you're self-employed or you qualify under other categories. We can help you set those things up. Now, one thing we can't do very often is if you currently work for a company, right? Let's say you work for Microsoft and you're actively working there. They typically do not allow you to take the money out while you're still working there unless you've already hit retirement age. That's what's called an in-service distribution, and you can just call your HR person and ask, do you allow in-service distributions? And if they say yes, then we can roll that money out. But most of them say no. Um, we can also do health savings accounts. I have access to be able to do this on a 529. I've never done a 529 plan, but I do have access to that. Um, Life insurance, things of that nature. This covers the conversion process. That's a topic for another day. So, but the point is we can get money from just about anywhere, right? So let's talk about how to strategically build your portfolio. Let's dive into this next for a few more minutes as we're almost done. I know there's a ton of slides here and I'm throwing a lot of information at you. If this interests you at all, there's going to be a QR code at the end. Bear with me here and there's a way to book a call with me, ask more questions, etc. All right, so building a strategic portfolio. The first thing you need to know is what's your financial freedom number? Excuse me while I take a drink. Financial freedom. So we're not talking about uh, personal plane, have jets all over, jet setting style lifestyle. We're talking about first things first. Pick your ideal lifestyle. Don't worry about money. What is it you want to do on an ideal basis and on a daily basis, a weekly basis? What kind of life do you want personally? And you got to figure out what number that is. And it's going to be different for you depending on where you live and what the cost of living is there, what your tastes are, all that kind of stuff. But this is important, right? When you're talking to an advisor, you need to know what that is. What is your financial freedom number? What do you need on a monthly basis? And then we work backwards to build it. And then depending on your situation, we got to figure out, do you need, core assets that are going to have, predictable cash flow, like those debt funds, for example, or like what I call a down the fairway. I don't know if you can tell I golf once in a while, but a down the fairway asset that is already stabilized. It's going to pay a lower return, but it's going to be very, very solid and have no volatility. Or do you need to continue growing, right? And getting into some growth assets. The way I really think of this, I actually think that we need to look at them into three different buckets. So just like those advisors we talked about in the beginning of this call, where they set up a 60-40 portfolio for you, stocks and bonds, I want to do the same type of thing in these private equities. And so what we'll do is we have 25% of someone's money going into debt funds that pay 12 to 15% on an annual basis. 50% going into core equity assets, things like apartments, mobile home parks, RV parks, maybe marinas fit in there. These are going to pay about 20% annualized. But again, mostly equity, right? So it comes at the end. And then you got 25%, the last 25% to go into some more speculative investments. These are things like that paving deal I told you about earlier, the roads, the oil wells, these a little bit more speculative, like the bourbon, right? The bourbon fits in there. These are going to pay 40% on average, but it is a little bit more speculative. We do a really good job. We're going to talk about due diligence here in a minute. We do a really good job of identifying all the risks and trying to mitigate them, but these are all investments, right? Just like the stock market, they can go up and they can go down. So the 80-20 principle is really, really something to think about, right? And what that comes down to is we want to eliminate as many risks as we can. And we do that through due diligence and proper due diligence. Now, I'm going to talk about, three key slides here, things that I think are very, very important, but we're not going to go through our entire due diligence process because honestly, it took me an hour to explain it to you in detail. The high level is we start with a subscription level background check to make sure the people are most important. Then we have a third-party underwriter that fact checks all the numbers on a deal that we pay lots of money to. And we have a questionnaire that I answer 240 questions about the deal to try to find any potential problems. And the thing's growing all the time. And then the last step is we do a private investigator level background check on all of the sponsors before I ever put a dime into any deal, because it's very important to me before I ask you to put money into a deal that first of all, I would put my mom's money into a deal, right? Because that's my rule of thumb. If I would never put my mom's money in it, why would I put your money in it? That's what's really important to me. So let's talk about evaluating the sponsor, the person that's actually running the deal. In my opinion, the most important thing is who's the person actually running the deal, the boots on the ground, the day-to-day operator. And these are some bullets that are really, really important, but you got to really vet that person and make sure that they can do what they say they're going to do. That's the most important thing. Second thing, understanding the metrics of the business. I'm going to talk about each one of these things here for just a minute, right? You don't need to understand all of the lingo out there, right? On my website, I actually have a private equity, like thesaurus or glossary, maybe is the better term, with all of these different random words or abbreviations and things that we use. Here's four of them that I get asked about all the time to explain. Okay, so the first one is what's called a cap rate. And that sentence really describes it. It's income relative to price. And the formula simply is that price equals income divided by cap rate, or vice versa, right? Price times cap rate should equal income. Well, how do you figure out the cap rate? Now that one's a little bit more art than science, right? This is kind of like the comps in single family space. Like, what are people paying in today's market? A good rule of thumb, this is not direct math, so please don't hold this specifically, right? But a good rule of thumb is figure out what the interest rates are in commercial loans, right? And that'll give you a pretty good base point for cap rates. And I would say that's like middle of the road quality, maybe even a little bit middle to lower quality, possibly. And then you lower the cap rate because lower equals higher price. You lower the cap rate for more high quality products. Like if it's brand spanking new, maybe you take a couple percentage off. If it's older, maybe add a little bit, right? And so again, it's just a rule of thumb. If you ever talk to a broker, I noticed there's a couple on here. They're probably shaking their head saying, Senate, that's not exactly right. It's not exactly right. It's a rule of thumb. That's why I said it. All right, moving on. Second one, IRR stands for internal rate of return. Basically, this is adjusting your returns for inflation. A dollar today is worth more than it is worth in 5 years. This is my favorite metric to analyze deals with, is what is the internal rate of return, because again, it waits that time for us. It is also the hardest one to calculate, right? It's pretty complicated. You're probably not going to do this one in your head unless you're a savant, right? But it can definitely be done with an Excel sheet fairly easy. Okay. Second one, or third one rather, is equity multiple. This is just if you put $1 in and you get, how many dollars do you get out? So you put $1 in and you get 5 out, that'd be a 5x equity multiple. That's insane. They're not usually that big. If you put $1 in, you get 3 out, that becomes a 3x equity multiple. Pretty simple. But the reason I don't like this is because it doesn't even talk at all about the time. Think about this. Let's just say I'm doubling your money. That's a pretty good equity multiple. Well, what if I can double your money in 5 years? Pretty easy math, right? This is not compounding. This is straight math. So 100 divided by 5 is 20. That's a 20% annualized return. Pretty simple, right? But what if it's going to take me 10 years to do it? Now you take 100 divided by 10, and now it's a 10% annualized return. Very, 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 very different, right? Well, what if I could do it in 2? Now it's a 25x or 25 times return, 25% return, excuse me, 50% return. I did my math wrong. That's what I get for doing math live. So equity multiple to me is kind of a misnomer because it doesn't talk about time at all. All right, so cash on cash, there's 2 different types of cash on cash that I want you to really think about, okay? The first one is annual cash on cash, and you got to look at that one literally on a yearly basis, right? Because maybe Depending on some of these deals, there's no cash flow for 2 years if they're building something, maybe 3 years. And then there's cash flow in years 4 and 5. Or sometimes the cash flow does start in year one, but it's really low. Like let's just say it's a 2% in year one, and then it's 5% in year two, and then 7% in year three, and then 8% in year four, and 10% in year five, right? So you got to look at it on the annual basis. What I want to caution you from is looking at the average cash on cash and then thinking that that's going to be every year. Because that example I just told you, I didn't do the math again. I'm winging this, right? That part of it. So what did I say? 2, 5, 7, 8, 10. Right? The first 2 years, you get 2% and then 5% the second year. But that average is probably somewhere around 6. Again, I'm doing that in my head. So maybe it's 5.5, maybe it's 6.5. But if you're expecting 6% in the first year and only get 2, you're going to be upset. So pay attention to the difference between annual cash on cash and average cash on cash. All right. Next, last one, I want to talk about the market. You guys, if the operator is the most important thing, in my opinion, the market is the second most important thing. Because here's the thing, right? We can renovate a property. We can turn a property around. We can shine it up, right? Take a piece of coal, lump of coal, and turn it into a diamond. But if it's in a really crappy market, we can't fix the market, right? And so there's four things on here that you really got to pay attention to on the market. But you don't want to just look at the city, especially in a big city like New York or Los Angeles. You can't just look at that city. You actually have to hone in on the sub-market, right? So what I like to do when I'm analyzing a market is I start at, well, I guess US. I currently, today, only invest in the US. I may expand, but you want to look at the country and the laws, and then you want to look at the state it's in and those laws. Okay. If there's going to be tenants living in the property, I want to invest in a red state, not a blue state. I'm not trying to get political here. Okay. I don't care who you vote for, but it's a lot easier there. Let's say it this way: tenant friendly or landlord friendly, or maybe business friendly, if you like that. That's something that's really important to me. And then we look at the city, maybe even the county, right? But then the city, and then we zoom into the neighborhood. Okay. We call it a census tract. And we want to look at these 4 metrics and a few others on all those levels: state, city, census tract. Okay. All right. So what about taxes? Guys, we're almost done. Got about 10 minutes here. Got a few more slides, but we're getting really close. We're moving right along and trying to go fast. I hope you're all taking it in, writing down questions, things of that nature. All right. So taxes are absolutely critical on these investments because we have special tax advantages. I'm sure that you heard a few years ago, there was someone running for president. We'll keep his name out of this, but he got really slammed really hard because he didn't pay any income taxes. And they wanted him to release his tax returns so he could basically be audited by the general public. Well, I didn't go through his tax returns, but from what I understand, the reason he didn't pay anything is because he's investing in real estate and these other tax advantage investments. And what I'm here to tell you is that you have access to the same advantages that person does. You just have to know how to access them. So I'm going to give you a couple of just bullets here, right, on things that we can do. So the first one is depreciation deductions. So when you buy a single family house and you rent it out, let's just say you buy a duplex and you rent it out. Well, actually, honestly, anywhere that people live, you can write off the value of the building, not the dirt, the building, over 27.5 years. Now, if it's a commercial space, you can do that over 40 years. Well, what if we could get that 27.5 years all to come in year one? Well, it's not quite that good, but it's pretty close. Okay. We do something called a cost segregation, and it breaks all the components of the building up into chunks. This is going to be a 5-year bucket. This is going to be a 10-year bucket, right? And then that's a 27-year bucket. And we're able to write off everything that's in the first 15 years all of that into year one, right? And that did phase out over some time. So if you heard and say, Senate, I heard that was going away. Well, it just came back and it's here to stay, supposedly, right? Who knows? Taxes can change, but supposedly it's here to stay. So we can take all that value and pack it into year one. I have several investments that give 50 to 60, 70% of a tax deduction in year one. Sometimes we get them to be exceptional. That bourbon distillery I was telling you about, it's 140% tax deduction in year one, and then continue to have taxes down the road. Uh, anyway, there's some rules about what you can use these tax deductions for, so we need to have a conversation, either you and me directly, to talk about your situation, or talk to your CPA to figure out exactly how that fits for you, because there are some rules. So please understand that. And again, these are things that are asset backed most of the time. Either you actually own an oil well with the mineral rights, you're building a bourbon distillery, you're heck, I mean, I haven't done it, but some people do airplanes and boats, and they're literally doing the boats. But these things are tied to assets, infrastructure like roads, things of that nature, right? All right. Told you we're almost done, friends. Key takeaways, okay? Alternatives can redefine your portfolio safety. We talked all about how these have a lot less volatility and a lot less correlation to the stock market. Cash flow, you guys, is the most important thing. There's actually a saying in the apartment buying business, if it doesn't cash flow, let the grass grow. So, every investment I look at is like, I want to understand, where does the cash come to me, right? Well, to you, the investor, right? The individual investor, where does that cash flow happen, and at what intervals, and at how much? Strategy and due diligence are absolutely essential, in my opinion, most important, right? Because if you don't know a lot about this deal, it could go to zero pretty fast. And then tax efficiency enhances long-term results. All right. So that's what I have for you today. Next month, we're going to talk about the basics of passive investing. So we're going to get into some more specific stuff on passive investing, but still going to be pretty high level. Like literally, how do you do this? What is a PPM? How do I qualify as an accredited investor? Like, who can invest? So it's going to be pretty basic stuff, but it's going to be very, very informative. So if you enjoyed this webinar, please tell your friends and invite them to March. And this last one, this QR code, you scan this and it's going to take you to a landing page. You can get my free passive investing course. This is 7 days of content like this. And if you do sign up for that, I'd love for you to give me a comment about my beard, because it was a lot longer in there, and trying to decide if I want to grow it back or not. So I'd love your opinion. You can also book a call with me right on there. Let's book a 15-minute call, learn about your specific situation, and see how I can help you. My email address, phone number, and website are all there as well. Reach out to me. Any questions? I look forward to talking to you all again next month. Thanks, everybody.